Africa. Africa.
Africa. Africa.
Africa.
Africa.
Africa. Africa.
Africa.
Africa.
Africa.
Africa.
Africa.
Africa. Africa. Africa. If it's about Africa, then it's our business. Hello and welcome everyone to the Business of Africa podcast, where we bring big and small business matters right to your doorstep. My name is Duduzile Ramela, and it's an incredible pleasure to be in your company for this episode of the podcast. More so because of our guest. It's because of his generosity that you get to see us for the very first time. We usually broadcast via audio, but today we're doing a piece to camera. And maybe let's tell you how we got to get introduced to our guest. So the Wits Business School recently launched the Mervyn King Center for Good Corporate Governance, as well as sustainability. And that is where we got introduced to a legal mind. That is where we got introduced to a business mind. That is where we got introduced to the man who wrote the playbook of corporate governance, good corporate governance in South Africa and beyond. We also got introduced, may I say, to the father, the colleague, and the boss. An all-round good story to tell about South Africa, an all-round good story that we could not miss the opportunity, rather, of telling. And so that is how you get to see us, because of our incredible guest today on Meet the Business of Africa, Professor Mervyn King. Prof, thank you very much for your time on Business of Africa. Do we, or rather, which one do you prefer, Judge King or Professor King, because of your legal background as well? Or doctor.
Call me Mervyn.
Thank you so much, Mervyn, for your time on the Business of Africa podcast. You have done so much in your life, but I'd like to maybe start with the formative years in your career, especially taking a look at law. How did you get into law and why?
Well, as a young person at school, I always wanted to study law. And in the days when I started at Wits, when I was at school, if you did well at school, they could push you up a year or two. So I did well, and they pushed me up, and I matriculated when I was 16. Sure. And I landed up at my first year at university, this campus, at the age of 16, which was 1954.
Sure.
So I don't know where you were to do it. 1954.
Probably not even a thought of my parents.
You were a glimmer in your parents' eyes. So I've been associated with it since 1954. So it's an extraordinary journey, actually. And in those days, you had to have a degree in order to do a law degree. And I did a BA majoring in philosophy and music. And I did very well in music. And the professor of music persuaded me to stay on and do an honours degree in music. The development of the organ music on the Witwatersrand, that was my thesis. When I did it until October, and I thought, what am I doing here? I wanted to be a lawyer. I'm wasting my time. So I switched immediately to start my articles and the study of law, and I never handed in my thesis. So I studied law, and I did very well. I got my degree cum laude, which you will see up behind you. And then I practiced as an attorney for a while, because I wanted to go to the bar. But, we've got the dual bar system in our country where the attorneys brief advocates to appear in court. But nobody knew me who knew me, and I came from a middle-class family. And so I spent 3-4 years practicing as an attorney to get to know the attorneys, and the attorneys get to know me. And that's where I first met Mr. Mandela, funny enough, because Mandela and Tambo established their offices right opposite the Fox Street entrance to the Magistrates Court. And I used to park there, and we started talking to each other, met each other. And then I practiced at the bar, and I became a silk, and I became a judge. And for reasons of conscience, I resigned as a judge. which I don't think is material to your interview. And many of my clients, I had a big commercial law practice, and many of my clients asked me to go on their boards. And I chose to go on the board of Kirsch Industries group of companies. And Mr. Kirsch, who was the controlling shareholder, his family, and I went about establishing the largest trading group in the Southern Hemisphere. We acquired Checkers, Dion, Stutterford's, Greatermans.
Sure.
It just became a massive metro cash and carry, and so it was a huge trading group we had. And that got into trouble in 1984, 85. I don't know where you were to do, but interest rates went to 25%, and everybody with borrowings, and of course we had borrowings in that large group, ran into cash flow problems. And that's how we got Sunderland to support us with a particular financial instrument, which was convertible. Either we had to repay on a set date, or they convert to ordinary shares in the group, which would give them control away from Kirsch Industries. And that's what happened. And Mr. Kirsch left South Africa, went to America, where he's a brilliant entrepreneur, and he's made a huge success there, his company in America. And I became chairman of the group, and that was corrected. In 1987, I was Businessman of the Year. And then I left that, and I became chairman of the Frame Textile Group. There were huge problems there, and it took me 12 years to fix up. And then I joined First National Bank, where I was director of the retail bank and chairman of the corporate and merchant bank. And we did the deal to reverse that into Rand Merchant Bank. It was an elephant into a mouse. But that is now First Rand Bank, as you know it. And so also I got appointed as chairman of the United Nations on Governance and Oversight. And so by the end of the 20th century, beginning of the 21st century, I became steeped in the question of our planet, the sustainability of our planet, and the way we had carried on business right through the 20th century, which the foundation was laid in the 19th century, the primacy of the shareholder. And everyone believed that the shareholder was in fact the owner of the company, but the company is a legal person on its own. It's got no owner, like I can't own you. You can't own a person.
Right.
And so that myth was debunked. And eventually, at the United Nations, together with the International Federation of Accountants, I and others developed to move away from this primacy of the shareholder to a value creation model. In other words, when a board made a collective business judgment call, it did it through three prisms, not only numerical, the economy, but through society and the environment, because what had happened was the increased profit through the 20th century was in fact subsidized by society and by the environment. For example, using child labor to reduce expenditure. And you just had a look around, you could see the degradation of the planet. You know, we building a new factory where we've got waste. Well, we will build it on a river bank and just push the waste into the river and save money to get rid of the waste. And that's the way companies operated. So the increased profit was being subsidized by society and the environment. And I started a whole discussion at the United Nations and with the International Federation of Accountants, to which, for example, South African Institute of Chartered Accountants belongs, that we as directors should really make business judgment calls making sure that we've catered for the three pillars of sustainable development, which is the economy, society, and the environment, and not just look at the numbers and not care that you might be further degrading the planet. And that operationally, the financial matters were integrated with the operational issues, the natural assets you use, the plant and machinery, human intellectual capital, and that these things were all integrated operationally. You didn't separate them. You never had financial capital in one building and human resource in another building and natural assets around the corner. It didn't work like that. These things are all integrated. And so King Charles, then the Prince of Wales, he had a trust called Accounting for Sustainability, and I became chairman of the Global Reporting Initiative. The Global Reporting Initiative was formed as a result of this analysis that the market value of companies has shown that only about 20% of the market value of companies of the great stock exchanges of the world was represented in the balance sheets and profit and loss statements. And the other 80% were the so-called non-financial aspects, or as it morphed into ESG, environmental, social, and governance issues. But we weren't reporting on them. So clearly we as directors were not discharging our duty of accountability. We have duties in law to the company, and we should report to the company, through the company, to all its stakeholders. And we had to have a business model which took account of these three critical pillars to make sure that you and I left a world where those who came after us could sustain themselves, because we were plundering the natural assets of the earth and polluting the planet at the same time. So more so in the northern hemisphere than the southern hemisphere. Mm-hmm. And so all this I started writing about, and then the Institute of Directors of Southern Africa in 1992. The first corporate governance code was written by Sir Adrian Cadbury in the United Kingdom. His remit was, and these are the exact words, the financial aspects of corporate governance. So you could see how the focus was still on the one aspect, the profit of the company. And in 1992, I was asked by the IOD of South Africa, would I form a committee to write a code suitable for the new South Africa, because we knew we were going into a democracy. So a country from unequal opportunity to one of equal opportunity. But those who were coming into equal opportunity hadn't been experienced in the unequal opportunity. So I said, let me think about that. And it so happened that afternoon, Mr. Mandela phoned me. He and I had many discussions together. We both enjoyed jungle oats, so we used to have breakfast together often. He lived in the house, and I also lived there.
With some milk, some bananas, some berries, or just on its own, good old-fashioned jungle oats?
So anyway, he phoned me and he spoke to me about what he wanted to speak about, and I said to him, Mr. Mandela, and I told him about this approach, and he said, do it. You're the right man. Just make sure no one charges money. Mm. And so I formed my committee, which was reflective of our new Rainbow Nation. And from that day in 92 until today, no one has ever charged a penny.
Sure.
But I've had the best people on that committee. And the work of the King Committee started going around the globe. Because what we said was, your governance, this was in the first report, which assumed my name as chairman, the King report. I didn't know then we'd do another one and another one, because so that became known as King 1 and then King 2. But what we said in King 1 was that the collective mind of the board should make a decision in the best long-term interest of the health of the company. because really your duties of good faith, care, skill and diligence at common law and in New Companies Act of 2008 is to the company, not to any particular stakeholder. So if you owe your duties to that company, you must report to the company and through the company to all the stakeholders. And but learn and understand the needs, interests and expectations of your stakeholder grouping. So when you make a decision, it usually is not doesn't look fair to one stakeholder, and it's better for the next stakeholder. But you get these trade-offs over the years, and the next time you make a decision, it's the other way around. That stakeholder benefits more from that decision. So you need, as a matter of fairness, to learn about their needs, interests, and expectations, so you can explain to a stakeholder why you made that particular decision. And when a company gets it right to make a business judgment call, which is in the long-term best interest of the health of the company, from a value creation point of view, but in a sustainable manner, there's no good creating value which is further degrading the planet, for example. And you get that right, then you have longevity, and the jobs of people, for example, are more secure. So that went around the world, and so I'm proud to say that it's been recognized, as you'll see behind you, around the world, and I'm honorary professor and doctorate in many universities and business schools around the world. And in June of this year, so it was 6 weeks ago, in London, I got a Lifetime Achievement Award from Accounting for Sustainability, which is now King Charles's Trust. The Institute of Chartered Accountant of England and Wales and Deloitte Global, they formed this Finance for the Future, and they follow this integrated thinking. And they say that's the future of finance, to actually get sustainability and the financial things to work together. And they gave me a Lifetime Achievement Award. And then in the last week of June, my alma mater honoured me with the Prof Mervyn King Centre on Corporate Governance and Sustainability. So I had a good June. And I also went to the Lord's cricket match, and I won, for South Africa become the world test cricket champion. So
we keep winning.
In June, I had one of the best months of my life.
And as it should be, and here's too many more best months of your life. Prof, I'd like to pick up on what you just mentioned, and thank you very much for that comprehensive breakdown. You mentioned that directors must make the best long-term interest decisions in the name of the company. With the work that you have dedicated your life to doing, what has been the observation? I was reading an article that spoke about the most common form of corruption in South Africa is bribery, and that falls on both the private and the public sector in South Africa, and it has devastating consequences. They cited research that looks at not only the economy, but the impact on you and I. And so with the work that you have dedicated your life to, what has been the assessment in terms of measuring how organizations actually apply it, so not just use it as a tick box?
Okay, a company, when formed, a limited liability company, which I've said around the world is the most important citizen in any country around the world, because when you think of South Africa, it's limited liability companies that create the jobs for people. So a very important person in society is the limited liability company. Because on that platform they raise capital, they create jobs for people. So the limited liability company is a person, but it's a legal fiction. You can't touch it. It's intangible. And you can get a certificate of incorporation, but actually the company is intangible, invisible. But the corporate governance architecture is that the people who contribute subscribe for shares in that company. A slice of the cake, say 10% of the shares of the company. subscribe for those shares in an initial public offering, and the money goes into the company. Those shareholders, in terms of the governance architecture, then select directors. What happened after the middle of the 19th century, when the first limited liability company was formed by statute, was that these wealthy families were the subscribers for these shares, and they started appointing their uncles, aunties, sons, daughters as directors. And other stakeholders, particularly employees, saw them as the owners of the company. And that's where you got the primacy of the shareholder through the 20th century. And the belief that directors must act in the interests of the shareholders, the theory being increase the wealth at the top and trickle down to the bottom. The trickle became treacle. It stuck at the top. Because the theory was they would invest in other businesses, but they didn't. They bought another yacht, another expensive motor car, whatever they did. That didn't work. Not only that, they ignored the impact of what companies were doing in making their products on society and the environment. Now, the foundation of a company carrying on business is, in fact, society, eventually your customer, your suppliers of product, financial assets, and the environment. Because without planet Earth, you're not going to get anything to feed your company, to start your business. So the bottom line is you cannot ignore those things. And when it says the duties of directors are good faith, care, skill, and diligence, the question's got to be asked, to whom do they owe that duty? And they owe that duty to this invisible, intangible company. They don't owe it to any particular stakeholder. Now, they owe it to this company. That company has no heart, no mind, and no conscience. So by definition, it's always innocent, because it can't commit a wrong. The same as an incapacitated human being can't commit a wrong.
Right.
But the directors therefore become the guardians and stewards of that company. And when something goes wrong, the wrath of society mustn't turn against the company. It must turn against those who are guarding the interests of the company, its assets, and its business affairs. And therefore, that those directors individually should think and collectively make business judgment calls which are in the long-term best interest of the health of the company. Because if you get that right, it's the best long-term interest of all the stakeholders. Mm-hmm. But if you focus just on one stakeholder, you're going to get the results which we've inherited, because right through the 20th century, it was focused on the primacy of the shareholder, with the consequences which we have today. Hmm. So it's very interesting that when something goes wrong, people start blacklisting or saying, I'm not buying that company's product anymore. But the company's never done anything wrong. But the question is, who was the rogue in the company? Which guardian turned to be a rogue? So I've always said, and I repeat in this interview, that you cannot, by legislation, I cannot legislate from tomorrow, Dudu, you will be an honest person with integrity. I cannot enforce it with a 10-year prison sentence even.
Right.
I cannot, because it's state of mind. And it's you think as to make sure that the incapacitated person, which is the company that you're acting for, the same as if you were a guardian of a 5-year-old incapacitated child, you would act in that child's best interests. You must do the same thing for a company. And you must plan for that child long term. The long-term health of that child, same thing for a company. Long-term health of the company. And you get that right, it's the long-term best interest. Now that thinking philosophy has now gone around the world. So the Bastille of primacy of the shareholder has been stormed by integrated thinking. And no organization today thinks still in silos, financial and, well, sustainability issues. We'll do a few things. These things have become integrated now. They can see the impact of sustainability issues on financial issues.
When we speak about the impact of sustainability, Prof, as we wind down the conversation, I was recently outside the High Court in Pretoria, and there's a lady who sells the best narkies on the side of the road. And interestingly, she had a bag for everybody when you purchase, whether it's a packet of chips or whether you purchase a narkie or an apple, for you to throw whatever it is that you have in that plastic. I thought that was fascinating because usually you just witness people eating something and then you throw it on the floor. So from the highest echelons of whether it's the business society right down to this lady who's on the side of the road that is making sure that she's got a packet for people to put in their trash. To your point about sustaining also the planet and for us moving forward, how important is it that this integrated thinking is followed from high up right down to the lady that is selling narkies on the side of the road?
Very important. So I always say it's better to talk about governing bodies and organizations. So you've got generic words rather than directors and companies, because every organization today is thinking on this integrated basis. They cannot, so a co-op, let's say in South Africa, cannot operate today and disregard what they're doing to planet Earth. They'll go out of business.
Yeah.
Why? Because they won't be able to raise capital. Because the banks, the capital markets of the world, do an audit on how the company is dealing with critical sustainability issues. They do that because they know the company won't last that longevity. And for repayment of capital, they want to make sure the company has got that longevity and successful longevity.
Prof, you have not stopped working, if it is a correct assessment, from 16, from the time you walked into BITS. Well, I guess before that, obviously, because you went to school, but in terms of starting with varsity, from the time you were 16 years old and you set foot onto this campus, and it sort of feels like a full circle moment with the launch of this center. What has kept you going? How have you been able to sustain this?
Well, first of all, I could see with my own eyes how our planet was degrading. I knew that as chairman and director of companies, that the limited liability company could really make a difference in the world. I knew as chairman of the United Nations on governance and oversight, where I spent 3 years and I really learnt about sustainability issues. I was steeped in it, at the United Nations. And so Kofi Annan was then the Secretary General. And I met with the leading accounting bodies in the world, leading legal bodies in the world. And eventually it was IFAC, the International Federation of Accountants, and the United Nations body, which I was the chairman of, came to 3 conclusions. That financial reporting was critical, but not sufficient to discharge the duty of accountability. Second, a sustainability report of how you were dealing with society and the environment was critical, but clearly not sufficient if you never had a financial report. Thirdly, if you did a financial report in a silo and you did a sustainability report in a silo, that would be divorced from reality, because you don't operate a company on the basis that the financial is here in Parkdown Ridge and natural assets is in Pretoria and intellectual capital is in Durban. It's not reality. These things are, in fact, integrated operationally. And so you should report it to the company and through the company, all the stakeholders, so they can see what's actually happening on a financial, social, and environmental basis, and how sustainability issues actually relate back to the financial and the financial on the sustainability issues. So that started driving me to work on this, and so I have, and I've been true, and the committee. I'm now chair emeritus of the King Committee because we decided I turn 88 tomorrow's my birthday, by the way.
Oh,
Yeah. So, I have since 1992 never charged a penny for the work I've done. Exactly what Mr. Linda said. Nor was any member of my committee, and I've had the best people in South Africa working with me. And now the chair is Nancy Ramela, who is a corporate lawyer, and she's at KPMG. And I've got there's fantastic people on the King Committee. And the other thing, it's, out of South Africa, always something new. Out of Africa, always something new. And I wove into the King Report the principle of Ubuntu. I am because you are. That, these things, we are together. And we must work this together. And so it's gone around the world. And it's fantastic that we are seen as the leaders in the world on the subject.
Prof, thank you very much for the work that you have dedicated your life to doing. And thank you very much for inviting us into your chambers. And thank you very much for talking to the business of Africa and sharing with us your deep insights. And we wish you many more delicious months and good months of wins, and happy birthday.
Thank you very much.
Thank you very much. And ladies and gentlemen, that is how we meet the business of Africa with Professor Mervyn King. We'll see you again in the next fortnight. We are on the following platforms: Moneyweb website and app, Iono, Spotify, and YouTube. Please remember to like, subscribe, and share.